In today's video, we will be digging into Nutrien, the Canadian fertilizer powerhouse that plays a vital role in the global food supply. They make things grow, but will they grow your portfolio? You'll have to stick around to find out. Nutrien was formed back in 2018 as a result of a merger between two industry giants, Potash Corporation of Saskatchewan and Agrium. These companies were both huge in the world of agriculture, with Potash Corp focused on potash mining and Agrium specialty in crop inputs and services. This merger created the world's largest provider of crop nutrients, inputs, and of course services. If we look closer at Nutrien's main products, potash, nitrogen, and phosphate, these three essential nutrients are the foundation of modern agriculture, and Nutrien has been a key player in providing them to farmers, well, all around the world. In recent years, Nutrien has also made strategic acquisitions to grow its retail network, which now spans more than 2,000 locations right around the entire planet. With a focus on sustainability and innovation, Nutrien is well positioned for the future. Join the conversation. Let us know in the comments if you hold Nutrien in your portfolio. Your participation, as always, is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. If we consider Nutrien's role in the world food supply, as the global population continues to grow, so does the demand for food. In fact, it's estimated that by 2050, we'll need to produce 70% more food than we do today. This is going to be a huge plus in the books of Nutrien. By providing essential nutrients to crops, Nutrien plays a critical role in increasing crop yields and ensuring a stable food supply. In addition, the company is also investing in research and development to create new technologies and practices that will help farmers become even more efficient and, of course, sustainable in the future. Furthermore, Nutrien is also actively addressing the challenge of climate change. Through their product offerings and sustainability initiatives, they are helping farmers reduce greenhouse gas emissions and adapt to changing environmental conditions. It is very clear that Nutrien is an essential player in the world food supply. But what does this mean for investors? For that answer, we need to speak with our good old buddy, Mr. Math. As usual, we're going to start with that surface data, and they have a market cap of $49.157 billion and a pretty stable beta of 0.88. Their earnings per share come in at it's a nice number, 19.23. Their price to earnings ratio comes in at 5.11 compared to the average in their industry of 12.2. This is a good indication that they may be undervalued, and we're going to touch on that in just a second. Their price to book ratio, it comes in at 1.4. The average in the industry is 2. Both that price to earnings ratio and the price to book ratio is indicating that they are more than likely undervalued. Let's switch over and look at their revenue. Their revenue comes in at $37.012 billion, and they have an earnings of $7.660 billion. Their projected earnings come in at negative 30.5% over the next 3 years. The industry is also in that same kind of boat, but with them, their projected is negative 24.9%. So they're a little bit worse than the industry when it comes to where we're seeing those earnings heading. Keep in mind, Nutrien's earnings grew by 142.9% last year, partially because of the Russian invasion of Ukraine. They stepped up and did their best to increase production and fill the hole in potash, which was created by that war. Basically, some of the earnings drop over the next 3 years is partially a correction. It may not be as alarming as it seems at first glance. Their free cash flow comes in at $5.672 billion, and they've got a return on equity of 31.02%. When it comes to fair value, we've already suspected that they're undervalued. I have a feeling this is going to tell us exactly that. Their current price, that comes in at $98.39. And once we apply that discounted cash flow model, we get a fair price of $156.25. Holy banana bread. They absolutely are undervalued by a whopping 38.5%. Okay, let's take a look at their returns. We'll start with their dividend yield. Their dividend yield comes in at 2.675%. That is paid out quarterly in the amount of 53 cents USD per share. They've got a payout ratio of 13.54%. So that dividend absolutely 1,000,000,000% sustainable. When we look at their returns, we'll start, of course, with the 3-year, and their price rose from $49.46 to $98.39. That is a return of investment of 98.93%. Total return comes in once we add in those dividends of 113.81%. That's not too shabby. That 1-year return, their price dropped from $138.46 to $98.39. That is a return of investment of negative 28.94%. And, well, the dividends don't help that much. They still have a total return of negative 27.03%. All right. A huge part of this big drop in their share price is the result of a drop in potash demand. They experienced a reduction in potash purchasing from both North America and Brazil, and that was mostly due to a weather-shortened spring planting season. Okay, let's take a look at 2023. So in 2023, they still dropped from $99.66 to $98.39. That's a return on investment of negative 1.27%. Add in the one dividend we've received so far this year, and we get a total return of negative 0.55%. Other than their 3-year, the returns have not looked super great. Let's take a look at the debt and see what's going on underneath the debt hood. When it comes to debt, their total debt comes in at $10.724 billion, and they have a total equity of $25.863 billion. That is a debt to equity ratio of 41.5%. This is a debt to equity ratio that was 53.5 cents about 5 years ago. So they have been moving their debt in the right direction. I have no complaints about that debt to equity ratio at all. When we look at their short term, their assets come in at $16.34 billion, and their liabilities come in at $14.28 billion. That's not too bad. Let's take a look at their long term. Their assets come in at $38.24 billion, and their liabilities come in at $14.44 billion. Once again, that's really not that bad. Overall, I have to say I do love this debt situation. They have a great looking debt to equity, and their short and long term balances look fantastic. Their debt and interest on that debt are well covered by their operating cash flow and, well, their equity before interest and taxes. So what is the final verdict? Nutrien is an interesting company in that much of its growth has been contributed to the invasion of Ukraine. However, this is really not accurate, as they grew by 96.54% from the beginning of the pandemic right up until the invasion began. Now, once that invasion did begin, it caused a massive peak in their share price as it rushed up to $142.20 per share. This huge spike in price is why their 1 year looks as dreadful as it does. I think this does have to be taken into account. We really can't put a lot of weight on that 1 year drop. When we look at their debt, it is really good, and they have the stability to recover and continue to grow. This is a very undervalued company, and despite the earnings shrink over the next 3 years, the share price is a different story. Some analysts are predicting a 1 year price target of roughly $120 per share. That's not too shabby. Nutrien is not for the short-term investor or the passive income-focused investor. However, it is a good stock for a long-term total growth strategy. The need for their products, well, they're only going to increase, and that does create a bit of a safety net. And I would go as far as to say it kind of gives Nutrien blue chip status. Nutrien is not a company I would actually be concerned of. It's more of a company if you are a total return investor that you can buy and forget. Keep the learning going. Watch my video on Canadian natural resources linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.